Happy Monday, family. It's the first week of 2021, so let's ease into the year with a quick look at 3 stocks that we'll probably only have to talk about once, barring any massive news or a stock market crash. You're watching Sekki들, and this is what we're watching for the year, aka 3 stocks to own in South Korea for 2021. Before I continue, I'd appreciate it if you could scroll down, hit the like and subscribe buttons and the notifications button to help you keep track of the content that we'll be releasing throughout the year. Also, just a quick reminder that these videos are meant for general education purposes only and not meant to replace paid financial or legal advisors. What you do is up to you, and what you should always be doing before doing anything with your money is research. Now let's get to it. In the past, we've used what we're watching to talk about smaller or less popular assets in the Korean market, based on the assumption that anyone doing stock picking in the ROK is already aware of the market giants. But let's draw from the old Jerry Belson adage, when you assume, you make an ass out of you and me. So today we're going to talk about 3 heavy hitter mainstay bread and butter companies on the Korean market, and we're going to start where everybody would expect us to start. Samsung Electronics. Need I say more? At this point in time, there may be no bigger company synonymous with Korean innovation than Samsung Electronics. In the world of phones, tablets, and daily use gadgets, Samsung is the Pepsi to Apple's Coke. On top of its phone, TV, tablet, laptop, and home goods technology, Samsung Electronics passed TSMC as the largest semiconductor manufacturer in the world, with strong and consistent demand for their DRAM technology. It also ranked 16th on Forbes 2020 Global 2000 list and 19th on the Fortune's Global 500 list. So, needless to say, owning shares in Korea's representative conglomerate would not be too bad of a purchase. Ya 이 새끼야, you might say. Doesn't everybody already know about it? It's likely overpriced, right? To this I say, let's look at the numbers, G. After soaring from 56,000won per share to 81,000won over the last 2 months of last year, it's still at a price to earnings of only 20 times. At a market cap of roughly $475 billion US, and with so much R&D setting up future growth and innovation, it's one of Korea's only global too big to fail stocks, and it's not that expensive. Now, this is not to say that it won't hit any bumps in the road, such as potentially disappointing 2020 Q4 earnings in the face of the new iPhone drop and the weakened US dollar, but if you're looking to dollar cost average into a company while putting the rest of your cash in a fund or savings for the entirety of this year, Samsung Electronics is a good go-to. Alright, the next company you can probably guess as well. I'll give you 3 seconds to guess without any clues at all. That's right, big boy, we're talking about Hyundai Motors. Since Toyota shifted its international focus towards luxury vehicles with its Lexus line, Korean car makers have pushed into the affordable car industry and haven't really looked back since. Also, although Kia is their supposed domestic rival, Hyundai Motors owns a third of Kia stock and works heavily in partnership with their sister company. Now, with the EV market exploding, and some may say inflated, where does Hyundai rank in terms of competitiveness? Well, to start, through the first 3 quarters of 2020, they ranked 9th in global EV sales, behind the strength of their Ioniq and Kona EV vehicles. Their Nexo, a fuel cell hydrogen-powered SUV, helped them top the list of hydrogen car manufacturers for the first 3 quarters of last year as well. And they have a long plan to release a line of 18 eco-cars following the global trend towards fuel-efficient vehicles. But what about the stock? As of last Thursday, December 31st, 2020, the stock was trading at a PE multiple of 43.43. Now, if that's outside of your PE range, that's understandable, and if so, feel free to skip ahead to the next stock. For those of you who see this as a stock being priced for growth, let's talk a bit more. Hyundai Motors announced at the beginning of last month that they were committing $55.5 billion towards EV development through 2025. This should be considered a positive sign considering the car maker's manufacturing capabilities. For those of you who don't know, Hyundai has a car part manufacturing arm known as Hyundai Mobis, and with the parent group's recent acquisition of GM St. Petersburg branch, they look to build their already expansive manufacturing ability both home and abroad. With plants in India, Russia, the US, China, Turkey, Brazil, and the Czech Republic, Hyundai's reach could continue to grow across the decade. Although not a great stock in terms of PE ratio specifically, Hyundai Motors' plans for innovation provide a solid foundation for growth in the future. Also, the car manufacturer had the 3rd highest revenues of any company in the Korean market, trailing only Samsung Electronics and SK Holdings. ultimately, Hyundai Motors is a strong company, but be advised that their stock may be overvalued at the moment, and you should do as much research as possible before deciding if you want to commit capital to the company in the short term. Finally, Posco. Posco is an industrial company that specializes in the production, research, and innovation of steel. The company itself has been a mainstay in the Korean market for years and has grown consistently in operating income every year. Moreover, the company aims to maintain and expand its position, having recently announced a plan to expand their hydrogen production to 5 million tons by 2050. That would be up from the current production of 7,000 tons per year. And this is significant as the move towards green energy picks up in earnest, particularly since hydrogen has an extremely high energy content. 1 kilogram of hydrogen is comparable to 1 gallon of gasoline, and by capturing the hydrogen emissions of the steelmaking process, Posco can reduce the environmental costs of their industrial activities. Long story short, Posco is aiming to capture the byproducts of their manufacturing processes for use as future energy as well as for use within their own manufacturing process. On top of all this, HHI, a company that we spoke about a couple weeks ago, recently announced a move towards LNG, or liquefied natural gas, and they aim to install more LNG fuel tanks within their freighters. The captured hydrogen, when converted to LNG, must be stored at very low temperatures, and it requires certain kinds of steel to ensure that it does during the trip that a freighter would make, say from Korea to LA. Needless to say, due to the R&D efforts that Posco has put in consistently over the years, they have a competitive edge, having developed special steel that caters to the super low temperature needs of LNG fuel tanks, and they can produce them at a lower cost than traditional materials because they've replaced the standard nickel with manganese-based steel. Manganese. I don't know. I dropped chemistry back in the day. Anyway, this is all to say. Posco's position as a world leader in steel manufacturing looks to grow as the world focuses more on green energy innovations, and they clearly aim to become a mainstay of the hydrogen production market. Now, looking at the stock, Posco could very well be a sleeper pick with its trailing 12-month PE sitting at 25.65, below the S&P 500's TTM PER at 27.4. It's currently trading at a PE ratio of 24.92, which may mean that the growth is not yet priced in. However, if we have a longer view of the company's future and the future of green energy, Posco could be a really good business-to-business industrial DeLorean, ready to take the future by the horns. Their recent commitment to provide cathode materials for GM's EV batteries show that they're already on the right track. Alright, that's enough from me. Hope y'all had a happy new year and you're staying safe. Also, I've seen some ugly news over the past week, and although it should go without saying, don't drink and drive. Be good, people. Also, I've been talking a lot about stocks, but don't forget about the Onuri Sangpungwan because them joints are an immediate return that are totally worth the purchase. Alright, bye.